Welcome back, future billionaires. Now, Howard Marks. This guy has been navigating the market for over 50 years, and I tell you what, he's discovered some things that no one else has. He recently revealed something he called a once-in-a-generation opportunity. He thinks the market is shifting in a huge way for the first time in over 40 years, and he says this is the best opportunity to enter. We're gonna uncover why this shift is happening, and most importantly, how you can leverage it to build true wealth yourself. So be sure to watch this video until the end. So, let's dive in. Marks kicked off his latest memo with a startling revelation. In his 53-year investing career, he has witnessed 3 sea changes, and we're currently in the midst of one. A sea change refers to a significant transformation of the environment, a complete shift in attitudes. The first was the fall of interest rates from 20 to 0 between 1980 and 2020, which had profoundly positive effects. The second was the opening of investors' minds to risk-return analysis. Before the 70s, the investor's job was to avoid risk. After the 70s, it was to take calculated risk. This was a monumental shift, and now we may be on the doorstep of the third. You see, this sea change is happening because the FED, central banks around the world, and the Treasury took decisive action to resolve the global financial crisis in 2008 to 2009. We've been living in a highly stimulated, very positive, easy money environment for roughly 14 years. Many people began to invest or enter the business in those 14 years, lacking a perspective on the period before the global financial crisis. They might think that the last 14 years was normalcy, but Marks disagrees. He believes it was the best imaginable period for borrowers and asset owners, but he thinks it's coming to an end. Here's the thing, Marks doesn't characterize the past 14 years post-financial crisis as a bubble, but rather as a hyped, unusually positive period when everything was easy for certain classes of people, particularly borrowers and asset owners. This, according to him, is abnormal. Now, to truly appreciate Mark's comments, you first have to understand the relationship between interest rates and asset values. Asset values are just a fancy way of saying things people own as investments, like stocks, bonds, and real estate. The value of an asset is based on the cash it will generate for you as the owner, discounted back to the present day using an interest rate. While this might sound a little bit complex, it's actually a relatively simple concept. Let's say you buy a stock that generates $20 in cash for you every year for 10 years. At the end of the decade, you can sell the stock for $200. You know how much cash the stock will produce, so the final step is to determine the interest rate used to discount those cash flows back to the present day. The reason you have to discount the cash flows is because of the time value of money. If you had to choose between receiving $1,000 today or $1,000 10 years from now, you would obviously prefer the money today. In this example, let's start with a 15% interest rate. Using that rate, we get a stock price of $150 per share. But what happens when we decrease that interest rate? Lowering the interest rate to 12% gives us a new stock price of $177. If we decrease that interest rate even further to 9%, the stock price rises to $213. If we bring the interest rate all the way down to 6%, the stock price skyrockets to $259 per share. Notice how the amount of cash the stock produces remains the same. The only thing that changed was the interest rate, right? The declining interest rate was powerful enough to push our stock price up from $150 a share at a 15% rate all the way to $259 per share at a 6% rate. This is an increase in the value of the stock of 73%, all while the stock didn't generate a single additional dollar of cash flow. As Howard Marks mentioned, this is what's been happening in the stock market and the economy for the last 40 years. In 1980, the US federal funds rate, a measure of the interest rates in the economy, was upwards of 15%. Over the last 40 years, interest rates have been on a downward trajectory. This trend continued until interest rates hit essentially 0% in the aftermath of the Great Financial Crisis and stayed there for years. 40 years of declining interest rates provided quite a tailwind for stock prices. The S&P 500 hit a low in the 1980s of 325. It finished 2021 at over 5,000. This is an increase of more than 15 times over a 40-year period. The last 40 years have been amazing for investors in the US stock market, which brings us to a key concern Howard Marks raised in the interview. The stock market and the economy are experiencing a once-in-a-generation sea change. The last 40 years were marked by continuously declining interest rates. We're now entering a period where investors will have to contend with rising interest rates. This sea change from a declining interest rate environment to a rising interest rate environment will likely be the defining theme for investors in future years. As Warren Buffett likes to say, rising interest rates are like gravity on stocks. As interest rates rise, this puts downward pressure on stock prices. Put simply, higher interest rates equal lower stock prices. When asked what the future interest rate environment would look like, Howard Marks had this to say: "I don't think we should expect to have stimulative rates all the time, so you better get used to higher rates for longer." Now, let's switch gears a little bit and talk about why you should be worried about inflation. But before we do, future billionaires, consider supporting this channel by hitting the subscribe button, as it helps us grow. You see, the inflation rate reached the 9.1% in June 2022, the highest in 40 years, and the Federal Reserve had no choice but to raise rates. The Fed was forced to raise interest rates at likely the fastest pace ever to reel in a runaway inflation. These rising interest rates weighed heavily on the stock market, because as interest rates rise, stocks become less valuable. The year 2022 was one of the worst years ever for the stock market, with the market falling 18%, making it the 7th worst year ever in the history of the US stock market. The year 2022 is up there with some pretty historical moments, such as the dot-com bubble bursting in 2002, when the stock market was down 22%, and the Great Financial Crisis of 2008, when stocks fell nearly 37% that year. Just for the cherry on top, 3 of the years were actually during the Great Depression, the biggest economic slump in the history of capitalism. The FED is committed to raising interest rates until inflation normalizes. Here is a simplistic example of how rising interest rates can hopefully cool inflation. The price of any good or service is determined by supply and demand. Low and declining interest rates cause demand to increase because it becomes less costly to borrow money to make purchases. The perfect example of this is buying a house. A $400,000 30-year mortgage at a 7% interest rate has a monthly payment of $2,661. The same mortgage at a 3% interest rate only has a monthly payment of $1,686. That's just one example, but the main takeaway here is that lower interest rates cause demand to increase. As demand increases, it causes the price of goods and services to rise, assuming a stable supply of those goods and services. This increase in prices is known as inflation. However, rising interest rates have the opposite effect. As interest rates rise, demand decreases because it's more expensive for people and companies to borrow money to make big purchases. If you're the CEO of a company and you're planning to build a brand new factory, you're probably going to have to borrow the money in order to have the cash to spend the millions of dollars required to build that factory. When interest rates are higher, it becomes more expensive for you to borrow that money. This means you'll likely have to build a smaller factory, or maybe not build it at all. This causes demand for all the products involved in building that factory, things like equipment, machines, shingles for the roof, etc., to decrease. We can see in our graph here that when demand decreases, that causes prices to come down. This is deflation, the opposite of inflation. Now, of course, this is obviously a simplistic example, but it demonstrates why the FED is aggressively raising interest rates in order to try to bring inflation down to a more normalized level. If it turns out that the FED is able to get inflation under control without raising interest rates to levels as seen in the 1980s, this will be a huge win for investors. Only time will tell, but this is what Howard Marks thinks will happen based on what he wrote in the memo he referenced in the interview. The underlying causes of today's inflation will probably abate as relief-swollen savings are spent and as supply catches up with demand. The FED appears likely to slow the pace of its interest rate increases. Marks believes that the base interest rate over the next several years is more likely to average 2 to 4%, so not far from where it is now. But here's what's truly interesting. According to Marks, the investment strategies that worked best over those periods may not be the ones that outperformed in the years ahead. So, what exactly should investors be doing now that things have changed? Here are 3 pieces of advice from Howard Marks himself. Number 1. Buy bonds instead of just stocks. If you invest, your goal is to obviously maximize the return your money generates for you. Typically, investors will include both stocks and bonds in their portfolios. However, until very recently, you almost had to invest entirely in the stock market in order to generate any return at all because interest rates were so low. If you bought a 10-year government bond in the summer of 2020, your yield was just 0.5% a year. That is way below the inflation rate, and it would be virtually impossible to build wealth at such a minuscule return. However, the yield on a 10-year government bond recently surpassed 4%, the first time this has happened in nearly 15 years. While 4% is by no means an incredibly high return, it is more than 8 times higher than the lows it hit in summer 2020. Number 2. Take less risk and still generate good returns. When interest rates are low, investors tend to make more risky investments in the hope of generating a return high enough to meet their goals. This is why you saw things like Bitcoins, SPACs, and meme stocks become so popular in 2020 and 2021. For large institutional investors like pension funds, this meant investing in things like private equity, venture capital, and real estate assets that are generally considered a little bit more risky than a vanilla portfolio of stocks and bonds. However, when the return of bonds increases from 0 to 4%, that high return from bonds causes the total return of the portfolio to jump from 5 to 7%. The pension fund is now meeting its return goals without having to invest in riskier things. This is what Howard Marks meant when he said that due to higher interest rates, investors no longer have to rely on risky investments to hit the return targets. Number 3. Build a cash position. There will be opportunities over the next 12 to 24 months. Until recently, money that you had sitting in your bank account was earning you an interest rate of 0%. After factoring in the impacts of inflation, your money was becoming worth less and less the longer you had your cash sitting in a bank account and not invested. In investing lingo, this is referred to as your opportunity cost, the investment return that you are missing out on by having your money sit in a savings account waiting for a good opportunity to come along. Here's one way to think about opportunity cost. Let's say the average annual return of the stock market is 7%. In recent years, the return you would get from holding cash would be 0%. The difference between the average return of the stock market and your return for holding cash is one measure of your opportunity cost. In this case, your opportunity cost of holding cash when interest rates are 0% is 7%. However, now interest rates are much higher, and your cash sitting in a savings account actually generates a better return. For instance, a high-yield savings account generates a 3% annual return. This means the opportunity cost of holding cash decreases to just 4%. While this is still obviously not ideal, higher interest rates result in a lower opportunity cost of holding cash. The longer the opportunity cost, the less you are penalized for holding cash. Howard Marks mentioned in his memo that now would be a good time to start building a large cash position to take advantage of any attractive investment, opportunities that may become available for the next year or two. I hope you enjoyed watching this video. If you did, give it a thumbs up and share with someone who might find it helpful. And if you want to see more videos like this, please subscribe to our channel and hit the bell icon to get notified of our latest uploads. Thank you for watching, and I'll see you in the next video.